It's early July of 2008, and equity markets all over the world are struggling with a number of issues right now. Really at the forefront is the question of inflation or deflation and which force is going to have the most impact over the next number of years. From a commodity perspective and a food perspective, inflation certainly seems to be the preeminent threat that the markets and the central bankers have to deal with at this point. But lurking in the background is deflation and the notion that there's been an awful lot of wealth that's been lost to the destruction of the housing bubble in the US and the credit crisis. The US is either in a recession at this point or what is likely to be a very extended period of subpar growth. And that has affected the global economy in terms of having growth ramifications, growth expectations ratcheted down significantly right across the world. The question I think that investors should be asking themselves at a time like this, amidst all of the uncertainty and volatility, is what should they be doing with their portfolios? How should they be conducting themselves to position themselves, A, through the short-term uncertainty that we're going through, but also so that they come out of this in the long run and are able to meet their goals and objectives. The first thing that I would suggest people do in that context is to look at the things that they can control in terms of their investment world. Certainly you can control the degree to which your portfolio is in cash or the degree to which it's invested in equities. But the first thing really to look at, I think, is to look at your asset mix and to ensure that your asset mix remains appropriate for your risk tolerance, for your time horizon, really to help you meet the objectives that you're trying to accomplish by investing. The second thing I think people should always be aware of is that their portfolio be properly diversified, and I think in times like this that's particularly important. Look at diversification both in terms of the geographic nature of your portfolio and in terms of the industry concentration, because it's in times like this specifically that non-systematic risk can really affect an investor's portfolio. You know, if you bet on the wrong horse, if you will, or if you have an over-concentration in the wrong theme or country area. Another thing that investors should be aware of is to take advantage of what the market offers during periods of volatility like we're seeing now. In the current environment, you could structure a portfolio of globally diversified companies that has a dividend yield in excess of 4%. And that at a time when the yield on government treasuries in the US, for example, is 3.9%, in Canada is a little bit less than that at 3.7%. And it's very rare in terms of investing and in terms of the history of investing that an investor can actually access dividend yields that are in excess of government bond rates. The final thing that I think investors should really be aware of in times like these is to not take on more risk than they're really comfortable with or that they really need to in order to achieve their long-term objectives. I've talked to a number of clients over the last couple of weeks who have said that they'd like to take more risk, that they'd like to see what the portfolio can create for them if they were to concentrate a little bit more. And it really is a difficult thing during times of volatility because even normal movements are going to be so much more dramatic than they might be at any other time, and that might test an investor's resolve. The other point to that is really that it's very unnecessary to take more risk during times like these. Because if you look at market sell-offs over the last 15 or 20 years, and even a little bit longer than that, following market declines of 10 to 15 to 20%, there have been incredible rallies that follow that. The slingshot effect, it's essentially referred to, where gains over the subsequent number of years, just with the market coming back into equilibrium, can be as much as 30 or 40 or 50%.